I'm Sopia with Global Pulse. Let me walk you through what I'm seeing right now because beneath the surface of the silver market, there's a story unfolding that most people aren't paying close enough attention to. And it's not just about price moves on a chart. Recently, silver found strong footing right around the $74 level. That wasn't random noise or luck. That area acted like a structural floor, and when price tested it, buyers stepped in and pushed it higher toward the upper 70s. We saw it climb toward 79 before settling back into the 77 range where it's hovering now. But here's the key point. A bounce doesn't automatically mean a breakout. It simply tells us the market respected a level. For a true shift in trend, we need to see aggressive conviction, sharp movement backed by meaningful participation. That kind of decisive surge hasn't happened yet. So for now, silver remains in a range. It's moving, but it's not committing. While Western markets appear calm on the surface, something very unusual has been happening in the East. A major futures exchange in Shanghai recently suspended additional trading accounts, bringing the total number of enforcement actions in just 1 week to 22. That's not routine housekeeping. Exchanges don't step in like that unless they believe trading behavior is distorting the market. At the same time, the price difference between silver traded internationally and silver priced inside China has widened dramatically. Physical silver in Shanghai is commanding roughly $9 more per ounce than the global benchmark. Think about what that signals. Demand for the real metal is staying strong even while paper markets move sideways or get pressured lower. This growing premium matters. It suggests that while futures contracts and financial instruments in the West are consolidating, physical buyers in the East are still willing to pay more to secure actual supply. Meanwhile, inventory levels tied to major Western trading systems continue to shrink. Registered silver holdings have dropped again, falling to roughly 93 million ounces after another significant withdrawal. Against that, the number of open paper claims tied to near-term futures contracts still represents hundreds of millions of ounces. That imbalance tells us something important. There are far more claims to silver than there is immediately available physical supply. Some of those claims have been pushed forward, rolled from one delivery month into another, which buys time for those who would otherwise have to provide real metal. But rolling contracts doesn't eliminate pressure, it delays it. And even after recent volatility, only a small number of participants stepped away from their positions. That suggests confidence hasn't been shaken as much as price action alone might imply. Another revealing detail comes from exchange-traded funds tied to silver. Despite a noticeable drop in price, only a relatively modest amount of silver left those funds. In other words, investors didn't rush for the exits. If a market falls sharply but physical holdings barely change, that raises questions about whether the move was driven by real selling or by trading dynamics that don't involve metal changing hands. Thin participation during sharp price moves often points toward algorithmic activity or leveraged positioning rather than genuine shifts in long-term ownership. Zooming out further, we're also seeing synchronized stress across broader financial markets. Different asset classes, equities, commodities, risk-sensitive investments have been declining together at times, even while bond yields softened. That's not a healthy rotation from one opportunity to another. It can indicate liquidity tightening beneath the surface. When multiple markets feel pressure at once, it often signals forced adjustments, margin constraints, deleveraging, or institutions pulling back simultaneously. Now add another layer to this: timing. The Shanghai market is entering a holiday closure period lasting more than a week. During that window, one of the world's biggest centers of physical buying steps back temporarily. Historically, such pauses have coincided with increased volatility in paper-driven markets because a major source of real demand is temporarily absent. In practical terms, it removes a stabilizing force, at least for a short time. At the same moment, global macro forces are in play. Inflation data from the United States continues to shape expectations about interest rates. If inflation appears stubborn, it strengthens the dollar and pressures metals. If it cools, expectations of rate cuts return, which can lift precious metals. Silver's reaction to these data points isn't emotional, it's mechanical, tied directly to currency strength and borrowing costs. From a technical standpoint, silver also faces overhead resistance near the low 80s. That level acts like a ceiling for now. Until price convincingly moves above it with strong participation, the broader structure remains vulnerable to downside tests. But technical patterns alone don't tell the full story. Geopolitics is quietly reshaping the monetary landscape. Around the world, major economies are gradually reducing reliance on the US dollar for trade. Increasingly, transactions are being settled in local currencies. Over the past few years, the share of trade conducted outside the dollar system has climbed significantly among some of the largest emerging economies. At the same time, central banks, particularly in Asia, have been trimming holdings of U.S. government debt while steadily accumulating gold. That shift didn't begin in response to market volatility. It accelerated after financial sanctions reshaped perceptions of currency neutrality. When nations see reserves frozen or access restricted, they rethink what constitutes safe assets. Gold benefits directly from that reassessment because it exists outside any single nation's control. And as gold gains strategic importance, silver often follows, not just as an industrial metal, but as a monetary companion. Even policy discussions inside major economies reflect this evolving mindset. Some policymakers are exploring ways to lower borrowing costs while rebuilding domestic industry. But history shows that sustaining lower rates while shrinking central bank balance sheets is extraordinarily difficult without eventually increasing liquidity again. If financial stress emerges domestically, new liquidity may remain largely inside national borders, while globally trusted stores of value gain importance in international settlement. That's part of why gold has risen even in the absence of a full-blown crisis. The shift is structural, not cyclical. Still, balance matters. There are risks to the bullish narrative. Silver hasn't yet reclaimed its key resistance zone. Market participants can continue using derivatives and contract management to defer delivery obligations. Institutional trading desks have navigated similar situations for decades. Short-term pressure remains possible, especially during periods when physical demand temporarily steps aside. But the counterweight is clear. Physical premiums in Asia are rising, not falling. Inventory buffers are thin relative to paper exposure. Investor confidence in holding metal-backed assets hasn't collapsed despite volatility, and enforcement actions in major exchanges suggest regulators are alert to distortions. Most importantly, when it takes coordinated effort across markets, combined with unusually light participation, just to trigger modest outflows, that's not a display of overwhelming strength. It can be interpreted as strain beneath the surface. So what should we watch next? Keep an eye on whether silver holds that mid-70s support or breaks beneath it. Watch whether it can reclaim the low 80s zone with conviction. Monitor how physical premiums behave when Asian markets reopen after the holiday pause. And pay attention to delivery dynamics as contract deadlines approach. This isn't about predicting dramatic outcomes overnight. It's about observing how pressure builds or dissipates over time. Markets reveal truth through behavior, not headlines. Right now, the behavior suggests a system where physical demand and financial positioning are pulling in different directions. And when that divergence persists, it eventually resolves. The only question is when and how decisively. I'm Sopia with Global Pulse.